Investing in bonds can be just as risky as investing in stocks. Here to help us sort out the action plan that you might need for your portfolio is Glen Schultz, a Performance Trust. Good morning, Glen. And let's just start with the bond basics. What's the difference between a bond, a bill, and a note?
That's really the maturity of the instrument. So bills have a maturity that are less than 1 year, and they're priced at a discount. Notes have maturity greater than 1 year, less than or equal to 10 years. They carry a coupon. And bonds have maturities greater than 10 years, and they also carry coupons. So the big difference between bills, notes, and bonds is largely where they sit on the maturity spectrum.
I'm sensing some investors may be feeling nervous right now because interest rates are rising, so those bonds are not worth as much as they used to be. They're opening their portfolio statements, not looking good. What would you do here?
Well, what I would do here is begin to shorten the maturity of my bond portfolio and at the same time begin looking for higher yielding instruments. That higher yield or higher coupon off of that will actually work with the maturity to reduce the risk of the portfolio. So bond prices move in the opposite direction of interest rates. The longer the maturity, the greater the price risk of the bond. So as you come in on the maturity spectrum, you have less price risk, and as you have more coupon income from that, you also reduce the price risk of the bond. So what I'm doing, a lot of investors are doing, is they're beginning to look to the loan market for alternatives to, say, the treasury bond market.
Here's another issue that's coming up. People are told, put your money into bonds because it's safe. And usually we see the stocks and bonds moving in different directions, but now they're moving in the same direction. What does it tell you as a trader? Should they be concerned?
No, they shouldn't be too concerned, but what we are seeing here is a dislocation between the normal behavior between the equity markets and the fixed income or bond markets. And this has really been brought on by the Federal Reserve's asset purchase program. So not only are they looking to lower interest rates by purchasing bonds, but they're also looking to raise the price of risk assets or equities through that program. So what's happened as people begin to factor in the tapering of the Federal Reserve's purchase program, stock prices and bond prices are falling together as investors anticipate an exit of the Federal Reserve's asset purchase program. And that's caused positive correlation. So normally in a portfolio you have stocks and you have bonds because stocks rise and bonds normally would fall. They're inversely correlated. And right now we're just seeing positive correlation. But at some point we'll return to a more normal market.
Good to hear. Thank you, Glen Schultz, a Performance Trust.
Thank you.